All right, let's dive right in. When you hear a company made a ton of profit, what does that actually tell you? Not as much as you think. Today, we're going to arm you with three powerful financial lenses to see past those big, flashy numbers and understand a company's true profitability. So, picture this. A company's CEO gets on TV and announces they made $1 billion in profit. A billion! Sounds amazing, right? But here's the real question. Does that automatically make it a good business? The answer, honestly, is it depends. That one number is just a single piece of the puzzle. To really know what's going on, you gotta look deeper. So, here's how we're gonna break it all down. First, we'll nail down what profitability really means. Then we'll look through our three lenses: return on equity, or ROE, then return on assets, ROA, and finally, return on invested capital, ROIC. After that, we'll show you why context is the absolute king, and we'll wrap up with a quick guide to spotting some major red flags. At its heart, profitability isn't just about the cash a company makes. No, it's about how well a company uses what it has to make that cash. It's all about efficiency. And a great place to start is from the perspective of an owner, an investor. Okay, our first lens is the one that every single shareholder cares about the most. It's called return on equity. You'll see it as ROE. This metric answers one simple, crucial question. For all the money I've put into this company, how much profit are you making for me? To put it simply, ROE is all about the return on the money that shareholders, the owners, have invested in the business. It's a direct measurement of how hard their money is working. And you know what? The formula for it is super straightforward. You just take the company's net income, its bottom line profit, and you divide it by the total shareholders' equity. It's profit versus the owner's stake. Simple as that. Let's run a quick example. Imagine a company has a net income of, say, $10 million, and its shareholders have $50 million of equity in the business. You run that simple calculation, and boom, you get a return on equity of a very healthy 20%. So what does that 20% actually mean? Well, here it is in plain English. A 20% ROE means for every $100 that shareholders have invested in the company, it's generating $20 in pure profit. Now that's a useful number. Now for our second lens, with ROE, we were focused only on the shareholders' money. Now we're going to zoom out and look at everything the company owns. This is the efficiency view, and we measure it with something called return on assets, or ROA. ROA asks a totally different question. It asks, how good is this company at using all of its stuff, its factories, its cash reserves, its inventory, the whole shebang, to generate a profit? This is really a test of a company's operational muscle. And the formula tells the story perfectly. See, we've still got net income on top. That's our profit. But on the bottom, we've swapped out shareholders' equity for total assets. We're now comparing profit to everything the company owns. So let's use that same company, the one with $10 million in profit. But this time, let's say it owns $100 million in total assets. Buildings, equipment, you name it. That gives us a return on assets of 10%. And here's the translation. A 10% ROA means that for every $100 worth of assets the company has on its books, it manages to squeeze out $10 in profit. It's a completely different way of looking at the company's performance, right? All right, it's time for our third and final lens. And you could argue this one gives us the clearest, most complete picture of all. It's called return on invested capital, or ROIC. This metric looks at all the money the company uses to operate, whether it came from shareholders or from taking on debt. A lot of smart investors see this as the ultimate litmus test for a business. Why? Because it measures the return on the entire pool of money the company has to play with, no matter where it came from. It's a true measure of value creation. Okay, I'll admit, the formula here is a little more complex, but for good reason. We take the company's operating profit after taxes, which strips out the effects of how much debt it has, and we divide that by the total invested capital from both owners and lenders. It's designed to give us that pure, holistic view of profitability. So for our example company, if it had an operating profit of $15 million and total capital of $120 million, its ROIC would be 12.5%. And as a general rule of thumb, anything over 10% is usually a sign that the company is creating real, sustainable value. So there we have it, our three lenses: ROE, ROA, and ROIC. But just knowing the numbers is only half the job. A financial ratio in a vacuum is pretty much useless. To make it mean something, you have to have context. Let's see exactly how that works. Okay, meet Company A, a tech firm, and Company B, a manufacturing company. Looking at these raw numbers, it's a blowout, right? Company A looks like an absolute all-star. And Company B, well, it looks pretty mediocre. But is that the full story? Let's add that magic ingredient, context. Company A's 25% ROE is great, sure. But when you see that the average for other tech companies is only 20%, you realize it's not just good, it's a top performer in its field. That's a huge confirmation. Now for the big reveal. Remember Company B's 8% ROE? Seemed low. But when you compare it to the manufacturing industry's average of 12%, yikes! You realize Company B isn't just a bit low, it's actually lagging way behind its peers. The context completely changes our understanding. So now that we know how to use these lenses, let's wrap up with a quick field guide, a few common signs to look for. The good, and maybe more importantly, the bad. When you see consistently high numbers across all three of these metrics, that's a fantastic sign. It's telling you the management team is a well-oiled machine. They're generating profit efficiently, and it usually points to a company that has a real, durable competitive advantage. But here is a classic red flag. What if the ROE looks amazing, but the ROA is really low? That gap between the two is a warning light. It often means the company is juicing its returns for shareholders by taking on a mountain of debt. It makes the ROE look great, but it adds a ton of risk to the business. It's like a sports car running on nitrous. It's fast, but it's dangerous. So that billion-dollar profit we talked about at the beginning, it doesn't tell the whole story, does it? But now, by using these three different lenses, ROE for the investor's return, ROA for operational efficiency, and ROIC for the true big picture, you can see a company's performance with so much more clarity. Which leaves just one question. The next time you're sizing up a business, which lens will you reach for first?
Disclaimer. Educational content only. Not SEBI registered. This is not a buy/sell recommendation. Invest at your own risk.